This is Adam with you again for a new summary. Have you ever looked at your bank account and felt like you were trying to solve a Rubik's Cube while someone was actively changing the colors on the stickers? We live in an era where we have more financial freedom than any generation in history. We can trade assets at 3 a.m. from our beds, we can apply for a loan with a thumbprint, and we can buy fractional shares of a company in another hemisphere. But here's the paradox. With all this freedom, the average person feels more trapped than ever. Today, we are doing a massive, deep-dive exploration of a book that I believe will be the Bible of 21st century economics. We're talking about Fixed: Why Personal Finance is Broken and How to Make It Work for Everyone by John Y. Campbell and Tarun Ramadorai. Released in late 2025, this isn't just a how-to guide. It is a forensic autopsy of a system that the authors argue is fixed, rigged, not by a secret cabal, but by the very math and psychology of the modern world. In this hour-long journey, we're going to peel back the layers of the cross-subsidy trap. We're going to look at why financial literacy is actually a myth used to blame the victim, and we're going to debate the radical idea of public option financial advice. Whether you're a seasoned investor or someone just trying to escape the paycheck-to-paycheck cycle, you cannot afford to miss this. To understand why the system is broken, we have to go back to understand what was broken before. Campbell and Ramadorai start by explaining the institutional retreat. Think about your grandfather's generation. He likely had a defined benefit pension. The technicality here is crucial. The investment risk and the longevity risk were held by the corporation or the state. If the stock market crashed, the company's actuaries had to figure it out. If your grandfather lived to be 100, the pension fund had to keep paying. But starting in the late 20th century and peaking today, we've moved to defined contribution plans like the 401k or private IRAs. The authors call this the individualization of risk. Suddenly, you are the actuary. You are the portfolio manager. The technical problem: cognitive bandwidth. The authors cite a landmark study showing that most people cannot correctly answer 3 basic questions about compound interest and inflation. Yet, we have built a multi-trillion-dollar economy that requires you to be an expert in both just to have a dignified old age. This is the first fix. The system expects humans to be perfectly rational calculating machines, when we are actually tired, busy, and prone to emotional panic. Now, let's get into the rigged part of the script. This is the cross-subsidy trap, and it is the most technical and controversial part of Campbell and Ramadorai's thesis. In a competitive market, you'd expect people to pay for what they get. But in personal finance, the sophisticated users are subsidized by the naive users. Think about credit card rewards. If you are a transactor, someone who pays their balance in full every month, you are getting 2% or 3% back in free money. But where does that money come from? It's not from the bank's kindness. It comes from the interchange fees merchants pay, which raises prices for everyone, and most importantly, from the interest and late fees paid by revolvers, people who carry a balance. The technical term here is regressive redistribution. The system essentially takes money from the poor and the middle class who make mistakes, like missing a payment or not understanding a teaser rate, and hands it to the wealthy who have the time and education to game the system. The authors argue that a market that relies on exploiting the confused to reward the informed is a morally and economically broken market. Moving from the wallet to the home, let's look at your mortgage. For most people, this is the largest financial contract they will ever sign. The authors dive deep into the technicalities of the 30-year fixed-rate mortgage. While it's seen as a safe haven, it creates a massive knowledge gap. When interest rates fall, the smart money refinances immediately. But Campbell and Ramadorai's research shows a staggering refinancing inertia. Millions of households, disproportionately lower-income households, stay in high-interest loans even when they could save thousands a year by switching. Why? Because the friction is too high. The paperwork is 50 pages long. The fees are opaque. The authors call this an inertia tax. The system is fixed because it makes the correct choice difficult and the expensive choice automatic. Their solution: automatic refinancing. They propose a technical standard where mortgages are smart contracts. If the market rate drops by a certain percentage, your mortgage rate drops automatically. No application, no credit check, no predatory brokers. Critics say this would kill the mortgage-backed securities market, but the authors argue that the current market is built on the unearned profits of human procrastination. Now, let's talk about the stock market. We've all seen the ads: trade for free. Beat the market. Campbell and Ramadorai are brutal here. They show that for the retail investor, active trading is a wealth destruction machine. They explain information asymmetry. By the time you hear about a stock on social media, the institutional high-frequency algorithms have already priced in the news and moved on. The authors advocate for life cycle engineering. Instead of a portfolio of stocks, we need Target Date 2.0. These are funds that don't just balance stocks and bonds, they balance your entire life. They look at your job security, your human capital, your home equity, and your expected social security, and they adjust your risk profile automatically. The goal: to remove the human from the cockpit. Because, as they say, the pilot is the most dangerous part of the airplane. Now, I want to pause and add some critical perspective, because we have to look at the whole picture. The biggest criticism of this book is that it is too paternalistic. Critics argue that by shoving people into safe defaults, we are taking away their agency. If a person wants to take a risk on a high-interest crypto loan to start a business, should the government stop them? There is also the moral hazard argument. If the government fixes everything to be safe, if mortgages refinance themselves and retirement is automatic, will people stop learning about money altogether? Will we become a society of financial infants who don't know how the world works? And then there is the innovation argument. Critics point out that the complex products Campbell and Ramadorai hate are often the tools that allow for massive infrastructure projects and global trade. If we over-regulate the complexity, do we slow down the entire engine of capitalism? The authors respond by saying, "We don't expect people to build their own cars to ensure they are safe. We have safety standards. Why should money be different?" It's a debate between freedom to fail and the right to safety. As we approach the final stretch, we have to talk about the how. How do we actually fix this for everyone? The authors propose a public option for financial advice. In 2026, we have the technology to build a fiduciary AI. This wouldn't be a chatbot trying to sell you a credit card. It would be a regulated public service AI that has access to your tax returns, your bank feeds, and your goals. It would give you the unvarnished truth, telling you that you're paying for a car you can't afford, or that your investment fees are 1% higher than the industry average. This would bridge the advice gap. Currently, high-quality financial advice is a price only the rich can pay. A public option would democratize smart money. So, how do you use this book today, before the laws change? Campbell and Ramadorai suggest you build your own financial starter kit based on 3 principles. First, transparency. If you can't see the fee, you are the fee. Second, default over decision. Automate every good behavior. If you have to decide to save every month, you will eventually fail. If the money vanishes before you see it, you will succeed. Third, the complexity tax. View every complex financial product as a tax. If a broker is trying to sell you a complex insurance policy with an investment component, they are charging you for that complexity. Stick to the generic versions: index funds, term life insurance, and fixed-rate debt. At the end of the day, Fixed by Campbell and Ramadorai is a deeply hopeful book. It tells us that we aren't stupid or lazy. We are simply biological beings living in a digital, financialized world that wasn't built for our brains. The authors argue that the next great civil rights movement isn't just about income, it's about financial architecture. It's about building a world where the default path leads to prosperity for the many, not just the sophisticated few. We need to move from being victims of a fixed system to being the architects of a fair one. It was been Adam with you. Thanks for listening, and see you soon in the next summary of Top Financial Book. We're going to keep diving deep into the ideas that actually matter for your future. Don't forget to like and subscribe if you found this valuable. It helps the algorithm find other people who need to hear this message. See you soon in the next summary.